And let's welcome our market master for the morning, Krishna Kumar Karwa, the Managing Director of Emkay Global Financial Services, joins us. Good morning, Mr. Karwa. Thank you very much for joining us. At these nearly stratospheric levels, are you getting an uneasy feeling of buying more?
Honestly speaking, if you look at it, that we have had a run of almost 700-800 points on the Nifty in the last 40-45 days. And at the 8500 odd levels, you feel that the markets should be more in a kind of a consolidation kind of phase before they start moving up next. So I think the markets are looking for the next round of triggers post the diesel price deregulation. And hopefully if there are some triggers either from the ongoing parliament session, etc., then things could further move up. Otherwise, I think we are headed for a period of consolidation before we start looking towards the upcoming budget.
Okay, there seems to be a bit of a divergence with reality in the sense that the second quarter earnings were nothing to write home about. The macro data are not really turning the corner. Auto sales, which my colleague tracks very closely, continue to be damp. So do you think the markets will look for an excuse to correct? And would an absence of a rate cut on December 2nd be that excuse to correct?
I believe that as far as the 2nd December RBI policy, RBI statement, as markets are not looking at a rate cut in that meeting. In fact, if you look at the consensus poll of various experts, etc., and even including our internal understanding, we believe that again status quo would be maintained as far as December 2nd is concerned. So that should not be a trigger for correction in the market. Markets will probably, as they are, as you can see now, also they seem to be more of in a consolidation mode. And I think they will consolidate on their own steam, and finally it will be individual stocks that which will have their own correction based on the results they have given and what kind of outlooks that they have. So I don't believe that this could be a trigger for a market correction.
Okay. All right, there's some news coming in from Avanta Holdings where they say that it's the same news, but they're saying that the share sale in Crompton Greaves is a one-time transaction in order to cut their debt. So the funds that they get from this to the tune of, I think, 900 crores, that's what Animesh was telling us, that will be used to cut the debt in the parent company's books. Mr. Karwa, good morning. So you did mention that you're expecting to see a consolidation, but is this still a buy on dips market for a retail investor? And if yes, what are the pockets of of value that still exist in this market now?
Yeah, I think what we need to understand is that we are expecting recovery both in the GDP and the earnings, etc. And this is not just a 6-month story. What we are looking forward is a 2-3 year kind of a structural improvement in the economy and accordingly stock prices. So from that perspective, investors should be looking to steadily, regularly invest rather than trying to time the market. And it's very difficult for any investor to be able to do that. So if there are corrections, it's good enough because that's an opportunity for you to invest. And otherwise also I think it's best to, Indian investors are underinvested into financial assets and specifically equities. And so it's time to increase their exposure to an asset class which is expected to do well in the next 3 to 5 years.
Okay, let's speak about specific stocks, Mr. Karwa. Let's take the Nifty. Everyone's gung-ho in the long run, and much of the gung-ho has already come. Now what would be a 12-month target for the Nifty?
See, Nifty will finally track the earnings, how the earnings grow, and so from to that, put a number to that will be a function of various factors. But more than that, I would say that within the Nifty also there would be a huge segment which I believe the financials is a segment that should give you very good returns from the current levels itself. So that's one segment that we are bullish on. But otherwise, I think on the Nifty, who would have expected that we would be at 8,500 a week? 45 days ago, we were around 75, 7,600. So I think that's a function of too many things.
Okay. Okay. No, what I'm asking is that do you therefore expect that earnings will grow in a year, and therefore I'm not asking you for a near term or a March target. I'm asking you for a 12-month target, assuming that you are expecting growth to kick in by then. So another 10%, 15% a year down the line looks safe for the Nifty?
It should possibly be there. I mean, the odds are that it should be up by at least 10 to 12%. But having said that, let's look at it this way, that we have had a very good run in anticipation of improved earnings. So it could possibly happen that your earnings will improve and your stock market will possibly be in a consolidation phase. Okay. So I think investors should be prepared for that also. But having said that, a 10-15% uptick on the indices in the next 12 months is a distinct possibility.
Okay. As we speak, Mr. Karwa, the big positive for Indian markets is the way crude has been falling. Now Brent is below $77 a barrel. Which are the sectors or companies that one can buy now to play this falling crude theme? So say, the paint sector, the tire sector, which are the pockets that you would be interested in now?
Falling crude prices, because India is basically, is a large importer, so it's across the board very, very comfortable and positive for India, the falling crude prices. So I think the way to look at, rather than trying to do a direct correlation, the better way to look at it is that overall, what kind of an uptick on the GDP is possible because of falling crude prices. That's the primary premise that you should be, we would be looking at. But if you want to zero in, then obviously with the diesel deregulation, etc., then you have your oil marketing companies. They will be relieved a lot of their subsidy burden, and so there could be a structural opportunity in those kind of companies. Because valuations are reasonable, and now they should. So that is one segment. And as you rightly said, yes, the paint segment, they are a beneficiary not only from falling raw material prices, but also we have seen that they are basically price makers, and if there is improvement in domestic consumption as well as in your automobile segment, then paint companies will be a primary beneficiary in the immediate term.
Okay. When you started off about the Nifty, you said that you would bet on financials. Mr. Karwa, which part of the financials? Would you go ahead with the public sector, the private sector banks, which have run up significantly, or now do you think you're closer to a turnaround in the public sector banks?
See, there are two ways to play. If you are looking to play growth, then obviously with the kind of capital adequacy that the new generation private sector banks and maybe some of the old generation private sector banks have, their ability to grow is much better than the public sector banks, because they have their own challenges in terms of their capital adequacy. And so you have your new generation private sector banks, which still offer you good opportunities for growth. But having said that, your public sector banks, the valuations are very, very reasonable. There is a reason for that. But if you believe that from a 12 to 18 month perspective, your interest rates are going to come off and your economy is expected to improve, and that will help a lot in their NPA recovery, then from a valuation perspective, you have pockets in public sector banks also, which could also give you equally good returns.
The interesting part this month, Mr. Karwa, has been that both defensives and cyclicals have seen an up move. So technology names like Infosys have also moved, and PSU banks like SBI have also moved. But say for the next 6 to 12 months, do you think that defensives will overtake cyclicals? How would you play this argument now?
Honestly speaking, it's a challenge to keep on moving between various segments of the market. So I believe that the best thing to do is that as long as the quality of your portfolio is balanced, and that's the best way to move ahead. If you mentioned Infosys, yes, the valuations were at a discount, and for obvious reasons to the market leaders, and but the sentiment has turned positive into favor of the stock, and the expectations with the change in the top management is that the things going forward will be much more superior. So that's the reason why Infosys has outperformed. But I would believe that investors, investors should be invested in financials, in pharma, in IT. I think you should have a balanced portfolio rather than trying to keep on moving from segment to segment based on short-term thought process.
Okay. Mr. Karwa, actually we wanted your attention more or your views more on the mid-cap end. Do you expect the mid-cap index itself to be a major outperformer in a 12-month period? And more importantly, identify specific stocks. You know, sectorally, all of logistics has gone up, all of auto ancillaries have gone up. Do values look stretched? Tell us where values lie according to you in the mid-cap space.
Yes, for a mid-cap, from a 1 year, 2 year perspective, it seems that the mid-caps have run up sharply and have outperformed the large cap indices. But if you look at the mid-cap indices from a 5 year perspective, still there is a lot of catching up that the mid-caps as a whole have to versus the large cap indices. So primarily, you may from a short-term perspective feel that they have run up sharply. But I believe that still in a growing economy, it's the mid-cap stocks which will tend to give you outsized returns versus the large cap stocks. So that's the basic premise that we work on. But having said that, I think mid-caps, you cannot brush all mid-caps with the same brush. You will have to be very, very bottoms up in terms of identifying and investing in them. There, rather than trying to do sectoral attempts in terms of which are the sectors and then I would like to look at which mid-cap to invest. I think it's primarily based on bottoms-up kind of an approach where valuations and individual growth opportunities should be the key theme. You mentioned about auto ancillaries. Yes, I think if there is a recovery in the HCV cycle, then many of the auto ancillaries which have been struggling for want of growth, and also many of them have been developing good export opportunities. So they should do well, and I think they are also reflected in the valuations that many of the stocks have gone through. So we are bullish on auto ancillaries. We have seen the kind of growth which an Amar Raja has had, and we still believe that despite it having run up so much, it could still give you good returns. Other stocks that we like in agrochemicals, or we like Tata Chemicals, that's again a large mid-cap, again where we believe that the balance sheet size correction in terms of debt reduction which is happening should add to the enterprise value and the market cap of the company. We are again bullish on United Phosphorus, where we believe that versus peers, the valuations are much lower. It's a global company available at very, very reasonable valuations. So I think the list is endless as far as where you need to be on a bottoms-up basis rather than trying thematics.
All right, we leave it at that. There's some problem with the video, but we got the best of your stock list that you told us. So thanks so much, Mr. Karwa, for joining us.